So these are really tough issues to wrestle with.
We need everybody to speak out, so yes.
What would we do differently?
We have to start thinking further ahead, and we can do it, and we must do it.
That was a great panel on another perspective on communication. As many of you know, AREDAY strives to actually cover these issues from all over the spectrum, from climate communication as well as popular communication, and so we're really happy about that. This next panel is really talking more about institutional capital. For many of you guys who heard the earlier panel on renewable energy, there was a lot of loans and equity and debt structures for renewable energy projects. This particular panel is really more around how institutions get involved in these areas, not just through loan portfolios, but also really around, fundamentally being a part of this, and that's where the trillions of dollars are located, is more in institutional capital. So, without further ado, I'd like to transfer power over here to Sally Rainey.
Well, this panel is about institutional and private investment in a clean energy economy. And what we want to look at is, we want to look at this from three different perspectives. From the institutional perspective, private investment, private individual or VC investment perspective, and also from program-related investment, which is what some, although very few, foundations are doing. And so I'd like to introduce our panel. We have Joel Surface of Clean Range Ventures, and he was formerly with Kleiner Perkins. And he's now the entrepreneur in residence at NREL, the National Energy Laboratory here in Colorado. Deborah Schwartz is director of the program of related program investments at the MacArthur Foundation. And Tony Pajeras is vice president of investments at Morgan Stanley Smith Barney. So we're going to start this with some presentations, and then we're going to open it. I have a few questions, and if we have time, we're going to open it up to the floor for questions. Okay, Joel.
Oh, I thought we were going to start with the public side of it.
It's yours.
It's mine.
It's yours.
Excellent. Well, I did not bring a presentation, so all I'm going to kick off and say is a little bit about how we look at the evolution, the maturation of the private clean tech markets. And so just by way of background, I'm a guy that grew up in West Texas in the oil patch. I've been in the traditional energy industry, was a chemical engineer, worked in traditional utilities, advising them, as well as in the petrochemical industry and so forth. And that really shaped, the pragmatism of what's necessary to actually scale energy to the masses and building on existing infrastructure to get the most out of it. But I was also one of the early clean tech investors in Silicon Valley with Sierra Ventures and with Eastman Chemical Ventures, looking at how do we actually take these ideas from lab to market. Silicon Valley is the center of the universe, per se, in terms of taking ideas from lab to market. We learned a lot in the IT and biotech space, and we took some experiments in the energy space. But I found that there is a different model that needed to be looked at in terms of how do we massively scale renewable energy to the marketplace. So my assertion was, in addition to having the innovation engine working in Silicon Valley and other places, we also needed to take the next step further, which is engage the traditional energy industry and use their experience, use their infrastructure, use their ability to develop lands, to develop large-scale infrastructure projects, to do project finance, to do industrial scalability, to be able to do energy trading and energy risk management, and bring them into the equation to help massively scale that. So I went to Texas for a period of time to try to engage with Houston. I ran an incubator there to get companies up and running and hand them off to that industry. What was a challenge with that was it was very early. There were some early entrants on the traditional energy side that were coming into it. They built the wind industry in Texas. It's been a very successful story there. But what was missing is how do we take those ideas in innovation and marry them to an industry that expects all the risk to be squeezed out of those technologies and have mature technologies to go deploy. How do we bridge that gap? How do we cross that divide, not only philosophically, but also from a risk and finance perspective? So at that point, I was actually invited by Kleiner Perkins to come out to Colorado to hang out at the National Renewable Energy Lab for a year, to be the first entrepreneur in residence there. What NREL taught me is that between innovation and deployment, you need to have a couple of additional assets. That is market maturation. And that means, with respect to the National Renewable Energy Lab, almost every major renewable energy technology formed here in the United States has its fingerprints on it in terms of maturing the manufacturing process technology or analysis to be able to get it out to the market, whether you're talking about First Solar, whether you're talking about Clipper Wind Energy, whether you talk about even GE Wind, which was Zond and Enron Wind at the time. They have their fingerprints all over that. So if you're going to bridge that divide, you need to invest into this maturation engine and engage other maturation centers to do that. You also need to make sure that we leverage the market intelligence that's been built up over the last 10 years to not make the same mistakes or try to find the best ideas that you can bring to the market as quickly as possible. You also need to make sure that as this market has matured from the days when I first started investing into this over a decade ago to where we are today, we have major market companies. We have GE, ABB, Siemens, and everybody else moving into the market. We have major vertical market companies like Vestas and First Solar and SunTech and so forth that have built out their value chains. So now there are more opportunities as we look forward to fill in incremental improvements within those value chains to get those value chains lower in cost and more mature and get more ideas to market. So all those different things are things that have really kind of transitioned from where we were, which is Clean Tech 1.0, where I started over a decade ago. We were pushing a lot of technologies to market from the Silicon Valley, to today we're in a Clean Tech 2.0 market, where it's much more market driven. The market's matured considerably. We know that we can't push disruptive innovations out there, that we need to deliver more incremental innovations that we can get to market faster, that we get a higher return on investment for, that we can actually broadly deploy. We also need to look at how do we leverage different forms of innovation, open innovation, to solve critical early problems to get these ideas to market faster rather than keeping things in a black box. How do we engage in the traditional energy infrastructure, listening to the market to understand what the market needs to get those ideas out there faster? And then also, how do we go prove out those technologies between that step of market maturation and large-scale market deployment? And so what we look at is creating more test integration facilities. When I was in Austin, Texas, I had the privilege of working with the city to turn it into a living lab to create this thing called the Pecan Street Project that Jim Marson talked about yesterday from Environmental Defense. We founded that with the principle of proving out these technologies in a real-world grid environment and then bring as many as you can to go validate those. If you validate those, you can hand them off to other utilities to expand that market much more quickly. So all those different components are maturing, and that's what we call the Clean Tech 2.0 investment market, and that's what we're addressing. So one other point about what we are as a venture capital fund. When I came out here to Colorado to be able to work with NREL, one of the things that became obvious to me is Silicon Valley and Massachusetts have done a very good job of putting their resources, their IT and biotech investing resources, and applying it to renewable energy. And so we did a little study here in the region, which was, we looked at the rate of Department of Energy investment into Colorado and what we call the Clean Range region, from Idaho down to Texas, all the way over to Mississippi. Basically the flyover states that actually happens to be the breadbasket of renewable energy deployment. And so we said, how much money is being spent from a venture capital perspective as a ratio of that DOE money that's coming in here? And here in the region, in Colorado alone, we get about $800 million a year in clean tech research from the Department of Energy. If you look at the broader region, there's over $1 billion of Department of Energy money coming within the region. 70% of the EERE budget in terms of research comes to the region. And about $2 billion in total research comes to the region. But there's $0 of dedicated venture capital investment or firms that are addressing that early stage opportunity to go create companies. But in Silicon Valley, what we found when we did this ratio analysis was for every dollar of Department of Energy funding that was happening there were $2 of venture capital being spent. When we looked at Massachusetts, we found that for every dollar of DOE research that was happening there were $4 of venture capital going into those ideas. When we come to Colorado, probably the best research state and well, actually, it is the best research state in the world, anywhere, for clean technology, with National Renewable Energy Lab and other major research centers, Colorado State, Colorado School of Mines, University of Colorado, and so forth. We found that when we did the same analysis, that only 12 cents of venture capital comes in for every dollar of DOE funding. And if you look more broadly in the region, we only get 48 cents on the dollar for every dollar of DOE research. So we have a capital misallocation problem. That 12 cents and that 48 cents almost exclusively comes from the Silicon Valley and Massachusetts. But if you had the venture capital on the ground, working with those innovation centers, investing into the teams to be able to go form those companies, we would actually create a whole new generation of companies that are more pragmatically driven towards the markets that they're addressing here in the region. And so we're addressing that opportunity with Clean Range Ventures. So I hope that gives a little bit of a background on what we're doing. And as we go further in the panel, we can actually compare and contrast where the private capital meets the public market capital and so forth. Okay. Yeah. You wanna go?
So my name is Tony Pangeris. I'm a vice president with Morgan Stanley's clean tech investment banking effort. I brought a couple of slides with me just to address what we've been seeing in the public markets, and obviously in the clean tech public markets, which is a very important outlet so that these venture capitalists have a place to send their babies when they're grown up and ready to go. Are there slides up? How do I click?
You need a different slide deck. Power to it, man.
Yeah, I can just, I will start without it. So quickly on Morgan Stanley, I mean, we are a major player in the capital markets. We employ a global workforce of over 62,000 people across 42 countries. In 2010, we were fortunate to be #1 in global M&A, #1 in global equities, and #1 in global IPOs. We did $5.5 billion of fundraising for the clean tech sector in 2010 alone. We've been fortunate to work with a number of industry-defining clean tech companies, and we really pride ourselves on working with people like Joel and others out there to identify the leaders of clean tech and the leaders of each vertical. So here on this slide here, these are just a few of the companies that we've been working with. So whether it's companies like Amyris and Solazyme on the biofuel and renewable oil side, or if it's a company like Silver Spring that we raised some private capital for back in December of '09 on the smart grid side that is now on file. Beyond raising capital for companies that we think are changing the world, Morgan Stanley has a number of sustainability initiatives as well. We have a goal to reduce our greenhouse gas emissions by 15% by 2013. And we are also a signatory to the Carbon Disclosure Project. So I won't spend too much time on the eye charts here, but prior to the recent market turmoil caused by the sovereign debt crisis, 2011 was actually on a pretty good clip from a equity issuance perspective. Market windows certainly open and close, and I thought it'd be interesting just to look at sort of what was going on a year ago, because I think it does provide some recent learnings to how we may come out of the current dip. So in July of 2010, you'll see the market was wide open. Market volatility, as measured by the VIX, which is that green line there, was really in what we call the sweet spot for IPO issuance. Volatility began to rise in early August, and a number of deals were withdrawn, and pricing outcomes became uncertain. It really wasn't until the little dotted line thing on the bottom where follow-on equity issuance started to test the market. And basically companies that were already public started dipping their toe in the water, saw successful pricing outcomes in the market, and then that allowed people like Amyris to say, hey, well, if they can do it, we should try this as well. And then the rest of the market kind of came up. So what happened in 2011, and beyond obviously the Greek debt crisis and all the things you read about in the news, it's interesting to look at company earnings. And you'll see that on these two pie charts in the middle, Q2 was actually pretty positive. 74% of the S&P 500 beat their analyst consensus estimates for Q2. But then you'll see on the right-hand chart here that Q3 guidance was predominantly below street expectations. Market volatility, again going back to the VIX, has spiked. Instead of sort of that sweet spot that we look at to be 15 to 20, the VIX is now at 44, is where it closed on Friday. So we saw that 15 to 20 earlier this year and back in the market window of 2010, and that window is now closed. So you can see on the bottom left, our IPO backlog is certainly building with 141 IPOs on file waiting to get out. Now look, over the past 12 months, unfortunately, clean energy stocks have underperformed the broader market. Clean tech, as measured by the orange line there, is down over 18% over the last 12 months relative to the NASDAQ, which, believe it or not, is still up 7% from this time 1 year ago. A lot of people are questioning clean tech in the public markets right now, and they're saying, how is it that an established utility like Exelon that has a $28 billion market cap can have a 2.3 times valuation multiple on revenue, whereas a company like Tesla that has a $2.4 billion market cap trades at a significant premium at 3.8 times forward 2012 revenue. The answer to this is that investors are still willing to take that leap of faith. They're still willing to pay a premium for revenue growth, and that's allowing companies like Solazyme, with only $40 million of revenue in 2010, to hit the public markets with a $1.4 billion market cap. It's allowing other companies on this slide as well to achieve similar billion-dollar-plus market cap valuations with little revenue and no profitability at the time of IPO. Now, unfortunately, with the broader market downshift, stock prices of these recent clean tech IPOs have also come under pressure. And while we still see investor appetite for clean tech growth stories, it's going to take several months, we think, to get the next IPO window. Joel touched on this a little bit, and we might come back to this slide when we talk. But the private capital markets remain very active. $11.2 billion of venture capital and private equity was put to work last year, and you can see on the far right here, based on where we are first half of this year, on a run rate basis, we would come in at about $8.4 billion of capital deployed. Now, this does not account for the major slug of asset-backed finance, which this is strictly looking at venture and private equity investments. I think it's interesting if you turn your attention to the left chart here. If you just see on a global, the right chart was North America. The left chart is looking at global deployments of venture and private equity capital. And I think it's interesting to see that still the bulk of capital is going towards solar, representing 34% of all capital deployed. However, biofuels have gained significant private capital at 27% of capital this year. And look, I mean, we saw what I would call a white-hot IPO market for biofuels among public equity investors this year. And I think that you also see a lot of the venture capitalists saying, well, geez, I mean, if a company can go public with $1 billion valuation and zero revenue, why not fund some more of this stuff? Energy efficiency and energy smart technologies is an area where we expect to see future IPO activity. This includes lighting, smart grid applications, and software to drive efficiency in everyday operations of buildings and data centers. So we would really expect that to be the next crop of IPOs you see here when the market window opens again. So just to conclude here, and then I'll pass it along, kind of major themes that that we've seen in 2011, and a lot of these will carry on to next year as well. I'm sure a lot has been said already about federal policy, and we do not see any climate legislation or a national carbon tax in the near or even the medium term, which is unfortunate. Renewable portfolio standards at the state level have certainly played their role in kind of continuing to drive investment in the space. And beyond the corporations, some that Joel mentioned, like GE, Siemens, and ABB and others that are certainly taking a harder look at clean technologies, I think it's also interesting that the U.S. military is actually playing a major role in this. If you look at the U.S. Navy, they have a stated mandate to basically have 50% of their energy consumption come from renewable resources by 2020. So they're talking about renewable fleets. They are using biofuels to power some of these things. And another just fun fact here, the U.S. military is the single largest industrial consumer of oil in the world at about 125 million barrels annually. And every $10 increase in the price of a barrel of crude costs the Defense Department $1.3 billion. So it pays for the U.S. military and for everybody to kind of figure out how to get to cheaper oil, although in the current market we no longer have that problem right now. So look, to finish up here, we've seen clear government policy coming out of China and low-cost loans offering domestic companies a capital cost advantage relative to a lot of the U.S. companies out there. Abundance supply of natural gas. There are other speakers here that will tell you a lot about that. And I touched on private capital heading towards energy efficiency. We really see that as being the next class of clean tech IPOs. And then finally, mainstream electric vehicles have really hit the market in 2011. You've got the Nissan Leaf, the Chevy Volt. You've got the Tesla S coming out next year, and companies like Fisker as well. So a lot of activity here.
Good afternoon. I know Sally's eager to get us into conversation mode. I think I'm actually going to try to reach this without holding on to it. Okay. So there's another PowerPoint. You guys have it up? Okay. So I'm with the MacArthur Foundation. We're one of the largest private foundations in the U.S. We give away about $250 million a year. And I am not here from the program that works on the international side and has, for the last 25 years, been a leader in providing philanthropic support on environmental issues. I'm going to talk to you about 3 things today. One is the reason I am here, which isn't about being green. It isn't about making money. It isn't even about green jobs. I'm here because I care about affordable rental housing, and it's become a big focus for us to work on energy efficiency as part of our work on affordable rental housing. Second thing I want to do is share with you some of the investment opportunities that we're involved in and that others are involved in that I think are opening up opportunity for mainstream investors, pension funds, high net worth individuals, other kinds of institutions that need both market returns but also are looking for positive impact on the environment. And third, I want to leave you with a note of caution that we see as energy efficiency is rising as an imperative both within the marketplace and on the public policy front. Not at the federal level, but certainly in terms of local disclosures and other kinds of mandates that are starting to crop up. Really brief background. How many of you have ever heard of a program-related investment, which Sally mentioned? I see 2 hands. So do any of you know the part of the tax code that defines what a program-related investment is? Okay, so I'm going to say very quickly that if you're interested in program-related investments, you want to go to www.primakers.net. What you need to know for the purposes of my talk is that this is a way that foundations can really extend the reach of traditional grants by doing things for the exact same reasons that we do grants, which is to advance a charitable purpose, an IRS recognized purpose. But we get to do it using loans, using equity investments, using guarantees. We're allowed to get the money back. We're allowed to get a return as long as our primary goal is charitable. And what that usually means is that we take a below market return or we accept outsized risk. Why that's important for this conversation is that we've used program-related investments at MacArthur to drive a $150 million initiative over the last decade to deal with one of the biggest problems facing low-income people in this country, and that's the lack of decent, stable, affordable rental housing. That problem has only gotten bigger as we've gone through the foreclosure crisis and the Great Recession. We now have over 10 million households paying over half their income for rent. And if you're living on $10,000 a year and you're spending half of that on your rent and your utilities, you don't have a lot of money left over for food, education, or anything else. So that's why we've been focused on affordable rental housing, and the reason we've already put $7 million into energy efficiency specific projects in that sector is because this housing is really old, it is generally not very energy efficient, and utilities can be as much as 40% of the annual operating budget for an operator of affordable rental housing. So there's a lot of reasons to go after the savings, and you mentioned the Defense Department. HUD's budget, which is about $30 billion a year, it's estimated about $7 billion of that is directly or indirectly being spent on utilities. So this is another area where there's some real common cause between energy efficiency and fiscal responsibility. So, second thing I want to tell you about is how we're investing in energy efficiency, because it's creating opportunity for mainstream investors, and especially for investors who have some kind of emission focus. One of the earlier panels talked about the disconnect because a lot of these projects are small, and investors in general, especially larger institutions, need to be able to deploy capital in large blocks. So a key kind of institution that you need to know about and that has been playing an increasing role across the country are community development financial institutions, generally nonprofit lenders who work as intermediaries between the banks, foundations, insurance companies, and others who want to bring capital or who need to bring capital. An earlier panelist mentioned the Community Reinvestment Act. There's a mandate for banks to put money into low-income communities. But these transactions, some of them, if they're on a standalone basis, we're talking about making a $45,000 or $50,000 loan. That is just not economic or profitable or attractive to most community banks, let alone a JP Morgan Chase. So the way that we're engaging in this is we're providing low-cost patient capital to players like the ones on this screen, and then they are partnering with others, Johnson Controls, they're working with the Department of Energy, they're working with the Bank of America, and what they're doing is creating a way to bring money at the right scale and at an attractive cost to energy efficiency projects. I want to just leave you with one other set of examples of what's happening. Fannie Mae, with whom we're working, is introducing a series of new products that we think have real potential to bring energy efficiency to scale in the multifamily sector. Fannie Mae is known for single-family housing, but the truth is they're way more important, in fact, in the multifamily market, where they currently back a quarter of all multifamily housing finance in this country, and a half of all the new financing that's been issued in the last 2 years. They've introduced a new product that gives extra proceeds to owners who want to do energy upgrades. They're integrating green into their physical needs assessment for all their financing. They're going to be coming out with a green mortgage-backed security, a green supplemental mortgage, and we're working with them as well on the creation of an Energy Star rating for multifamily. So there is a lot of opportunity in the multifamily sector, and it is really exciting to me that my borrowers, the folks that I've focused on for over a decade, could in fact help open the marketplace for investors to do more on energy efficiency at scale. But at the same time that I see huge opportunity and a role for affordable rental housing, I'm very concerned. Because as we have new standards in the capital markets and as we see new standards from the local and maybe even eventually one day at the federal level, there is a risk that the standard for green will be so high that our affordable rental housing owners in this country, who are already the most constrained of all, because they're serving people with very little income and they're operating under regulations, that they won't be able to meet that bar. And we've seen a little bit of this already happening at the state level when LEED became something that you needed to have to access low-income housing tax credits. Just not workable. So as we go forward in scaling energy efficiency, please don't forget that there are other social goals out there, and one of them is housing affordability. Thank you.
So we've only got actually no minutes, but I'm going to take one or two, and these are some real basic questions, and anybody can answer these. Maybe you two probably. You mentioned that you don't, I think Joel, it was you that said that you really don't look at disruptive technology.
Somebody said we'll come back to your question.
Yeah,
please,
okay.
but-
So I'm curious about that. The reason I'm curious about that is because some of the disruptive technology, even that we've had at this conference, could really be game changers. And they're having a very difficult time in the capital markets getting traction. So that was one of my questions. Second question, which is linked to that, is what is the threshold risk for private investment that, Joel, you're working with, and the institutional investment, Tony, that you're working with? Is it the same level of risk? Is it a different level of risk? And what kind of risk management policies at particularly the federal level would help level the playing field so that more capital could go into the renewable markets?
So I guess I'll lead off on this, and I'll clarify. So we love disruptive innovation as much as anybody else. I mean, disruptive in kind of the traditional Silicon Valley sense is an idea that will change the value parameters of a given technology or market by an order of magnitude. Okay? So from a Silicon Valley perspective, investing in IT, that means you're creating new products. They're going to be completely de novo, that consumers will adopt very rapidly, high growth, high margin, and complete new product categories. And in the information technology space, you can introduce those very quickly and create huge, large new markets and in a short period of time, maybe 3, 5, 10 years. Energy is a little bit different though. Energy, it's not pushing technologies out to market. It's actually selling technologies to industrials where they're replacing existing technologies that have a 10 to 30-year asset life, where you're going to have to bring down the cost and reliability to such a point that it's almost a commodity value or a substitute technology. And what that means is it takes a little bit longer to be able to go from disruption to market viability. And there's a whole bunch of incremental innovations that have to happen to be able to bring down the cost, to create economies of scale, to create economies of learning, and so forth. So one of the things I pose to a lot of audiences is, what's the most recent disruptive technology in the energy space that is now achieving commercial market viability? It's on price parity with other technologies it's replacing. And rather than asking the question to the audience, some people often say solar. Well, solar has taken 150 years to get to price parity in the marketplace. 150 years versus 5 to 10 years, not a great thing to be doing something disruptive. The example I use is LED lights. The red LED light was created in the 1960s. The blue LED light was created in the 1970s. And that's the driver for all the white LED light general illumination that's being replaced today. And it's winning on a total cost of ownership basis in a lot of applications. But it's taken 40 years to go from a disruptive innovation in that space to commercial market viability. So the way we look at this is, we can look at this a lot of different ways. Yes, we can invest in a disruptive innovation, but we have to compress that cycle from 40 years to 5 to 10 years. And we think we can do that by leveraging those maturation centers that we were talking about, by putting the technologies in test and implementation centers, by working with customers to be able to whittle down on the key market parameters that we have to deliver to market very quickly to be able to get that adoption. But honestly, what it takes is it also requires you to invest into incremental innovations or tipping point solutions to get things to market faster, or enabling technologies to allow you to be able to integrate those existing technologies in new packages that reduce the cost that you can put out to market very quickly. So we look at a lot of those opportunities, but that doesn't mean we're ignoring disruptive innovations. It means we have to be pragmatic about how do we go take those disruptive innovations to market. One final point is, I mentioned this earlier, there are a lot of different ways to leverage existing innovation to apply to disruptive to get them down to reduce them to practice. You can't invent a disruptive innovation and expect to invent 10 other disruptive innovations around it to make it work. If you're going to invent one disruptive innovation, work on that, get it done, but complement it by bringing in existing technologies so you can put that entire package out to market faster.
Good point.
If there's time to add to that, all great points. I think the one thing, the market is still definitely funding disruptive innovation, both on the private and the public side. I mean, as of 3 weeks ago, maybe going this forward, we're in a little downshift period. But I think important to your point is that if you look at the way the cost of these technologies has come down. It wasn't too long ago that the cost of polysilicon, which is the core input for solar modules, was at $400 a kilogram. Today it's at 50 to 55 spot.
That was a market anomaly, though. So.
It was a market anomaly, but still, I mean, things like that have kind of kept renewables out of reach, and now poly's finally in the price where it's going to continue to decrease, and we're actually in the zone of getting to a sub $1 per watt module, I think, cost. Similarly, on the battery side, you have A123 saying that they see the cost of battery technologies dropping by 50% in the next 5 years. That's going to spur further electric vehicle growth and energy storage, and energy storage allows for a 24/7 renewable asset, and I think regardless of grid parity pricing. So there's a lot to be said there too.
And just a quick question, Deborah. You had, we were talking earlier, and we were talking about deal size matters, because a lot of the smaller companies don't get the funding that they need. And this is something that through your program and the efficiency program-related investments, where you're really helping to collaborate and coagulate some of the smaller companies.
I think the key point is there really are two different parts to the financing puzzle for energy efficiency in existing buildings. And even though I said we're not here because we're green, we know that existing buildings account for a huge percentage of the energy use in this country. So it is inherently beneficial from an environmental standpoint to address this. There is a really big difference between financing those improvements at the natural transaction points that every building goes through every 10 to 15 years. In those instances, you don't really have the scale problem because you're just embedding it in the same way that Fannie Mae is going to do a mortgage anyway. You make it include energy measures. The real challenge has been around standalone projects where you're trying to finance against the savings alone. And the truth is, for some part of the market, it makes sense. And when it does make sense, we can use community development finance intermediaries to make it work for the investor.
Okay, thank you very much. Thank our panel. Very interesting perspectives.
So these are really tough issues to wrestle with.
We need everybody to speak out. So yes.
What would we do differently?
We have to start thinking further ahead. And we can do it, and we must do it.